Good day, everyone. In today's episode of Fund Manager View, we have with us Mr. Sachin Shah, who is Fund Manager of Emkay Investment Managers. Good morning, Sachin sir.
Hi, good morning.
First of all, congratulations on Capital Builder completing 10 years.
Thank you. Thank you very much.
So, I would like to ask you, how has the journey been, particularly during difficult times like COVID-19?
Actually, 10 years sometimes looks as if it was yesterday, and sometimes it feels it's been a fairly long journey. But, if I have to think a little bit more objectively, right, from the fund management perspective, I think I'll break this up into two parts, right? When we started in 2013, I think from 2013 till 2017, it was like a dream run, right? The new BJP government came in with one of the best mandates that the Indian history has ever witnessed, right? And thanks to that, I think overall capital markets was in a jubilant mood. So the first 4 or 5 years were fantastic from 2013 till 2017. The last 5 years, right? I think from 2018 till 2023, even if I say it was a roller coaster ride, will probably be an understatement, right? It started with demonetization, then there was GST, then we had COVID, the lockdowns, which was absolutely unprecedented in the history of mankind, I would like to believe, right? And so that's one side. And then, of course, we had certain other challenges on the technical parts in terms of some ETF flows being very concentrated in few stocks during 2018-19. So, from 2018 to 2023 has been a roller coaster ride. There is no doubt about it. But I think, all is well that ends well. As you know, over the last 10 years, we have delivered 15% compounded return, nearly 15%, quadruple the money for investors.
Wow.
We've done quite better, much better than the Nifty 50 and Nifty 500. We've delivered almost 25% better than Nifty 500 and almost 40% better than the Nifty 50. So I think all is well that ends well.
That's great to hear. So, I would like to ask you next, can you highlight a key bedrock on which you were able to build a portfolio which has survived 10 plus years?
So I think, if I have to really summarize this, it's two words, right? Quality and discipline. The quality of the businesses, quality of the managements. We have never compromised on this too when it came to portfolio construct. We were very clear from day one that we will have only quality businesses run by quality managements in our portfolio. On the other side, discipline. Discipline in terms of, again, if you have to divide it into two parts. One is in terms of the portfolio allocations, right? We were very clear that we will have a focused portfolio. We don't want an overly diversified portfolio like 40, 50, 60 stocks. We always had this 20 odd stocks. 18 to 22 has been our sweet spot, right? And at the same time, making sure that there is no concentration risks, right? So no single stock will probably be more than 7.5 to 10% if it's large cap, not more than 5 to 7.5% if it's mid cap, not more than 2.5 to 5% if it's small cap. No single sector is generally more than 15 to 20%, except a large sector like BFSI, where the index representation of that sector has almost 35 to 40%. But over there also we are fairly cautious. Generally, we don't go about 25 to 30%, right? So, discipline as far as the portfolio allocation is concerned, and also discipline in terms of the temperament, right? Because investing is a lot to do with the game of temperament. And, when we talk about temperament, it's a function of not getting tempted with short-term opportunities, not getting tempted with some special opportunities, not getting tempted with some arbitrage opportunities, particularly when your focus has always been to the game of compounding, right? So I think these are two things which has really holded ourselves very, very well. We've steadied the entire journey in spite of all the challenges, and I think that is really the core of our entire investment philosophy.
That's great to know. The portfolio returns itself show that you have found a sweet spot.
That's right. That's right. Yeah.
So I'd like to ask you, can you narrate a couple of instances which would have kept you awake at night and question the process? So like you described.
Yeah, see, actually, again, portfolio outperformance and underperformance is as cyclical as anything. And this is across global fund managers, Indian fund managers. You pick up the best of the fund managers. Even if you take up a guy like Mr. Warren Buffett, to us, he's the ultimate god to my mind as far as the investing world is concerned. Even his performance has had cyclicality, right? So it is during those underperformance periods, and particularly a little longer periods, as a fund manager, as an investor, you start really wondering, you really start questioning yourself that are you doing the right thing? Is there something that you are missing? Like, I'll tell you a classic example, right? If I go back to the days of calendar year 2018, things were very, very challenging, right? In fact, in 2017 also, sometime second half of 2017 and early 2018, what happened was that there were humongous amount of ETF flows. And because these ETF flows were very concentrated only in those 10, 15 companies, because again, Nifty has, the weights are not equal in the 50 stocks, right? A single largest stock will have 10%, and then a few stocks will be just about 60, 70%. So even within Nifty, it was only those 10 stocks which was driving the entire performance, right? And our portfolios were MK Capital Builder, which are a multi-cap portfolio. So we had a very decent mix of large cap, mid caps, and small caps. In fact, we were truly, truly multi-cap because our allocation to mid caps and small caps was nearly 50% plus, right? And the benchmarks, right? Unfortunately, benchmarks are not in our control, but benchmarks, say a Nifty 500 or a BSE 500, the 70% comes from the Nifty, right? And when you have such flows, ETF flows, irrespective of the fundamentals of the business or the ground reality, it was just a pure demand supply kind of a thing. And the ETF flows were so concentrated, or the FII flows, which were actually ETF flows, which were so concentrated in just those 10, 15 stocks. So the headline indices were looking very good, whereas the large part of the market, nearly 80, 90% of the market was was not actually delivering returns. And this is something what we have actually documented also. If you go back to our quarterly newsletters, over this, so over this 10 years we have written 40 newsletters, right? Every quarter. So this is all very well documented at what was going through.
I have an example of it in front of me.
Yeah, so that is something which covers actually our entire 10-year history. But so the point is that it is during such times when we had, I would say, we lost our sleep for some time. The second instance clearly was March 2020, right? One single month minus 30%, and you wonder, minus 30% effectively means that over the last 4, 5, 6 years, you've lost 4, 5% compounded, right? Whatever returns you made, you've lost 4, 5% on an annualized basis of the last 5 years, right? So that is the time when you start wondering, does it make sense to be in equities or fixed income was better? But inherently we knew, we had this conviction that it's not those 1 year profits of the businesses which matters. It's the terminal value of the businesses. It's the recurring cash flows over the next 10, 15, 20 years, which creates the intrinsic value of the equity as an asset class. And, thanks to that belief, we were able to hold on to our portfolios. We stuck to our businesses, and, finally it has paid off brilliantly.
That's great, sir. So I'd like to ask you, how do you adapt to the changing environment of the markets or economy over the years?
So again, there are quite a few examples over there, and I'll give you two extremes out there, right? So for example, in terms of adapting to new things, for example, in the last 2 to 3 years, we've seen a lot of new age businesses now getting listed on the exchanges, right? Now, of course, these businesses have been here for almost now 7, 8, 9 years. And in the unlisted space, already the large private equity investors, large global investors have been a part of that. But as listed equity participants, I think we just have the opportunity in the last maybe 18 to 24 months. Now, a lot of people believe that these businesses may not do well because, they don't make profits, they burn cash and all of that, and which is true. But I think one very important point that we all should be very cognizant of the fact that the consumers, right, are glued onto these businesses. In fact, consumers are queuing up with these businesses. Whether it is Zomato, whether it is Nykaa, whether it is your C Info Systems of MapMy India, the consumers are very much at these businesses, and from that perspective, today these businesses are very, very relevant. At what valuation should we invest? At which point in time we should be in there is something that our research will decide. But we cannot just completely ignore. So again, this is a good example where we need to adapt to the new environment, to the new developments that are happening across the businesses, across the economy at the ground level, right? The other example which I can think of an extreme is, like for example, when the COVID happened, COVID was okay, but I think the bigger worry was the lockdown, which is absolutely unprecedented. And lockdown is not for a few days, few weeks, or few months, but this was for, I think, a decent period of almost 12 to 15 months, right? Now, during this period, a lot of businesses probably may become irrelevant, right? And not only that, those businesses did not have the balance sheet size to survive and stand during that period and come back very quickly, right? It is at that point in time also where we had to make certain portfolio changes, because we cannot take the risk that these businesses will become irrelevant when the new normal probably sets in, right? So there are certain, these are 2 or 3 movements where we have to be very agile and take those hard decisions. Otherwise, generally we are very structural investors. We would like to be as much long term as possible.
Understood. So, as a fund manager, what are the ideal characteristics you look for in a portfolio?
So, I think again, what we think is very clear, that the fun of investing in equity. What is the real fun of investing in equity versus an alternate asset class? Say, be it real estate, be it fixed income, be it precious metals. To us, the real fun of investing in equity is the game of compounding, right? It is compounding and compounding, which has to play out, because if you will see our 10-year returns also, on a compounded basis, we've done, say, closer to about 15% compounded. Maybe Nifty 500 has done about 13%, Nifty 50 would have done about 11.5, 12%. So on an annualized basis, it may look like the 2% kind of an extra return. But when you look at the compounded, which is the total returns, right? It looks like we've done 35-40% better. We've done 25% better, right? So it is this 10-year total returns and that compounding effect which actually starts playing out as you grow, as you are there in that journey. So whenever I see a portfolio, the first thing that I ask myself is that, do these businesses stand a chance to compound over a period of time?
Right.
And for that to happen, the first is, of course, the business opportunity has to be large for those businesses to go and exploit that. And second is, of course, does the management have it in them to go and capitalize on that opportunity? Right? So this is something what we are extremely, extremely focused about.
That's great, sir. Thank you very much for sharing these valuable
Sure. Thank
insights
you.
with us. Thank you for tuning in today's episode of Fund Manager View. That's it for today. Please subscribe to our channel so that you don't miss any future updates.